and welcome to Learn TV channel. My name is Nikola and I will be your host for this broadcast. Today we will discuss about risk management in the banking industry. For this topic, via Zoom, we will welcome the senior risk professional Dr. Yousef, who has a strong knowledge of Basel standards and COSO ERM. He teaches accounting and corporate finance for more than 20 years for undergraduate and postgraduate students in MENA region. He is inspiring leader to both team members and university students with a dedication to improving the risk landscape of any organization. Yousef, welcome to the show. It's a pleasure to have you as our guest.
Thank you, Nicholas. Good morning to all, and it's my pleasure also to be here, and thanks for the invitation.
Dr. Yousef, risk management in banking has been transformed over the past decade, largely in response to regulations that emerged from the global financial crisis. Just like any business, banks face a plethora of risks. However, given how important the banking sector is and the government's need in keeping risk in check, the risk weighed heavier than they do on most other industries. We would like to start with a simple question. What is a risk management and why is it important nowadays?
Very good. And also, I believe this is a simple but a very strong and the fundamental question. So the risk actually is the outcome of something which is going to happen in future, but we do not know the impact. We are not clear. So when we talk about the risk, we are talking about uncertainty. So we are uncertain about something is happening in future, but we do not know what would be the impact on us. And if we want to talk about risk management, in my opinion, is a systematic process which starts with identification of risk. Then we need to know what type of the risk is there. That means categorization or classification. Then it will continue with measurement and assessment. Then it will go with the risk acceptance, so the risk decision. Then we have reporting and monitoring. So this is a complete cycle. So if we want to talk about risk management, so we have a risk and we have a management piece. So the management piece is that systematic approach using the management skills or management capability to manage those risks. And the aim is to minimize the risk of organization or accept the risk within the risk appetite. This is a simple and very used definition of risk management.
What type of risks are being considered in banking?
In banking industry, I do believe there are two types of risks. In the very high level, like a helicopter view, if we want to look at the risk. So we have a financial risk. These are the main ones, financial risk and the non-financial risk. So in the financial risk, from a capital management perspective, we can say credit risk weight generally consume a lot. So that is one of the most important area. Then we have a market risk and also the credit risk. So these three, we can say, is a subset of the financial risk. The other side, we have non-financial risk. So the non-financial risk also, we have 3 or 4 main categories. One of them definitely is the operational risk, which talk about the people, system, and then also external and internal events. So these are and human capital. So these are operational risks. Legal risk also we have, and infosec, and some of them are not operational risk, like a strategic risk or reputational risk, which are not a result of operational risk within the organization. So in the broader level, as I said, we can categorize the banking risk in 2 main categories. A is the financial risk, and B is the non-financial risk.
Dr. Yousef, what are the key steps used to measure the key risks?
In banking literature, we have 2 things. We have 2 actually words we use. One is assessment, and the second one is measurement. In my opinion, the measurement goes more to the financial risk, where we are able to quantify risk. And the assessment goes to the non-financial risk because is the most difficult part. And a lot of banks and a lot of less organizations, they use subjects. To measure a risk, we have to look at several elements. Definitely, historical information helps us a lot. Frequency of happening in the historical information, that is another factor. The third one is using models to predict the risk. Let's say we want to measure expected credit loss for the purpose of IFRS 9 credit risk. So when you calculate this one, you use historical information, you use scenarios, you use mathematics and statistics. You use also macroeconomic factor, and then you train the data. And based on that, you will come with the probability of default of a customer. And when you have a probability of default, then you will come with the calculation of the ECL and the other elements. So the ECL is one component of the expected credit. Let's say ECL is one component of the IFRS 9, and in the ECL, to calculate that one, you have a PD. So PD is one element of the measurement. So another one will be the LGD and also EAD. So for the PD and LGD, so for example, we need to use point in time, let's say PIT or PIT, the people they say, to calculate the expected loss. So the measurement, just to conclude this part, we can say, okay, we need data. We need, let's say, capability to use mathematics and statistics, and also knowing the probability, because risk is always, always having two elements. One of them is impact or severity, and the other part is probability or frequency. So these two we have to use and to come with the measurement of the risk.
Dr. Yousef, which of the risks is more challenging to measure?
I do believe non-financial risk, especially operational risk, are more difficult to measure it or to assess. Let's say this is the most difficult part, and especially when organization is small. So when you have a small scale in terms of the scale of activity, the organization is small, then it is really difficult to measure because there is no data. With the small data, you cannot use it. So what do? You go with the expert opinion or subjective things. So that is the more I think harder part. In financial risk, I think the calculation when you use for the, let's say, prediction of a big scenario, let's say maybe in the market risk area, and also in the credit, the ECL, with the big data, it will be difficult and need a specific knowledge of let's say, of risk management, finance, physics, econometrics. That's my opinion. But in general, as I said at the beginning, the non-financial risks are more difficult to measure compared to the financial risk.
Like we mentioned in the beginning of this show, the Basel Committee sets out a number of standards and guidelines for bank risk management. Can you name them and what is their role?
Okay, the root of Basel Committee is BIS, the Bank for International Settlement, which is established in 1931 in the Basel city of Switzerland. So after Second War, and then because of a lot of challenges the banking, especially the banking system faced, in 1974, the Basel Committee was established. And one of the main purpose was to have a stable financial system across the globe. So this is the one of the main objective of Basel. So for this purpose, they produce a lot of documents. So the main, we can say Basel 1, Basel 2, Basel 3, and Basel 4. Essentially, let's say the Basel 4 we have. So these 4 documents, they mainly target the capital management. That means managing the capacity of the bank based on the risk. So it's like a risk-based capacity managing of that, and then also they came with the liquidity and market and the other one. So everything, these 4 documents are the main one. In addition to that, There's a lot of document about the corporate governance, managing operational risk, managing credit risk. And the most recent one in, let's say in the last few days, which shows the new trends also in the risk management, we can say one of them is definitely the impact of COVID-19 or in the credit risk area. So the credit risk will be impacted by the COVID, because after COVID, we need to do a lot of things, a lot of, let's say, government support was during the COVID, but after that, it will not happen. Then another point is ESG. So ESG is also one of the new things. The Basel Committee is working on that. Artificial intelligence, including the deep learning and machine learning, that's also another area of work which is happening by the Basel Committee and advising. So the Basel Committee is advising, because the BIS, the Bank for International Settlement, is the central bank for central banks. So they have a bigger role. And I think as a recommendation from the Basel, right these days, all banking industry, they are accepting as one of the best practices in managing, not only the managing the risk, but also the managing the banking industry.
There are three approaches that are commonly used by organizations to generate scenarios required for risk analysis. Can you name them and tell us more about their purpose?
Yeah. For the scenario analysis in managing organization, when we want, let's say most of the top team of let's say the C-level, the CEO or board, they ask, okay, give us your scenario. So usually in the scenario analysis, we use three scenarios. So we have upside, the downside, and the mid one. So this three scenario, in my opinion, the risk people, they should go with the downside. That means the worst case scenario. And we have to build the organization based on the worst case scenario. If we make it based on the worst case scenario, the organization will be stronger, optimistic in that it is really, we should not give a lot of weight to the optimistic one. Normally, it's a continual like this one. And these days, the environment is very dynamic. In economy, let's say the political and the geopolitics, and everything is very dynamic. So I think it's better to build the banking system and manage the risk based on the worst case scenario, and always have a buffer, because this will support your business to, let's say, to be stronger during the challenges, to be, let's say, alive and survive during the problem. So that is my opinion. And there are, as I said, there are three scenarios. Usually the people, they use three scenarios: the upside, the downside, and the mid scenario.
Dr. Yousef, what are the key risk indicators and their main feature?
Oh, good question. I think the key risk indicators are, let's say, key risk indicators are tools to measure the riskiness of an activity in the banking or any organization. So we have a set, let's say we accepted maybe the risk indicators are resulted from the risk appetite. We build it independent as a measurement tool to tell us, okay, the risk, my risk is, let's say, my situation, assume regarding the capital is getting worse, it's getting better, and we can use it also as a directional signal to manage our day-to-day business. This is a very, very important element. So a lot of bank or a lot of organizations, they use KPIs. I would suggest to use KPIs and the key risk indicator at the same time to manage their business. They will be benefited more.
We would like to wrap up by asking, can you name a few trends that are shaping the role of the risk function of the future?
One of the main one, and which I would always suggest to the board and the top management to use risk management in their day-to-day decision making. They have to build it. They have to embed it. Why? The reason is risk is enabler. Risk will enable you to make a better decision. This is my strong belief. So let's say if you have a strategy and preparing the strategy, allow them to come and sit with you and identify the risk. don't make yourself satisfied with using only SWOT analysis for the purpose of a strategy making. So use the risk one. So the risk is enabler, the performance enabler. How? By identifying risk and telling you, okay, change your way, do the other one, add the mitigant, let's say transfer the risk or avoid the risk sometimes. The second point is using artificial intelligence in the day-to-day monitoring. So in the non-financial risk, I think this element is working very well globally. In the other area, also in the financial risk, like a credit risk, a lot of, I think, banking system, especially the fintech and the new financial. So they are using also this the AI, the deep learning or machine learning, to predict the riskiness of the borrower. And I think it could be easily used in the retail customer when you have a large number of customers. And then also another trend is the controls become, across the organization, more, let's say, spreading in each and every area of organization. 20 years ago or 15 years ago, the people were talking just only focus on one element, maybe in the first line, maybe the second line, just only this one. But now is each and every element of the organization, in the operational side, in the business side, in the support side, in the, let's say, some of the organizations, some of the parts, they have a strategic goal. So each and every element, the risk control, they are getting there. And I think they're helping the people to understand more risk and also coming with a better decision. And other things I can say, the technology, in addition to the artificial intelligence, this one, I think that the technology use. And another shift in the risk management, which is happening in the last 20 years, is now the type of risk is changing from the financial. The weight and importance is shifting from a financial risk, like a credit risk, to non-financial risk, like InfoSec, the cybersecurity. Another one is like external events, like we have a COVID-19, that is a brilliant example. BCP, business continuity management, and then also managing the third party or the fourth parties. In overall, I think we need to think about more than 3 lines of defenses. In most of the literature, we can see 3 lines of defense, which is the front line is the business, the second line is risk management and compliance, the third is, let's say, the internal audit, the fourth, the people they should use also external auditors, and the fifth at the regulatory. So the central bank also should come as a big picture, because they have also in the broader level the responsibility of let's say, having a strong financial system, a stable financial system, because the stronger financial system will lead to have a better economy, and nowadays we can see. I think the Ukraine-Russian war also will lead to a lot of changes in the risk management landscapes.
Thank you, Yousef, for your insights and for being part of our show today.
Thank you very much, Nicholas. Thank you very much.
Thank you as well to everyone that tuned in today. Make sure to follow us so you don't miss our next episodes. Feel free to suggest a topic of your interest, and we will review the possibility of covering it in one of our next shows. Make sure to visit us on our YouTube and Vimeo channels, where you can watch the recording of this episode or many other episodes that we recorded in the past. Until next time, stay tuned.